Well, I think it's time to get started with the webinar. Thanks to those of you across Canada who have joined in, some at a very early time of the morning, some mid-morning. To those of you in Africa, thanks for joining us. And my name is Alan Franklin. I'll be the moderator for this event. I want to introduce our main speaker today, Annabelle Buzingo, who is an underwriter with the African Trade Insurance Agency. Annabelle is located in Nairobi, Kenya, and she will be talking about the various products that ATI has and how they can help investors who are interested in investing or doing business in Africa. And I want to thank her for agreeing to do this. For her, I think it's 6 p.m. in Nairobi. I hope all of you can see the screen that has the PowerPoint presentation, and I will be controlling the screen from, I'm in Vancouver Island, and she will be doing the actual discussion from Nairobi. So without further ado, I would ask Annabelle to start the presentation. Thanks very much.
Yes, thank you, Alan, and well, thank you, everyone. So as Alan mentioned, my name is Annabelle Buzingo. I'm an underwriter here at the ATI, the African Trade Insurance Agency. I've been working with ATI for I've been working with ATI for about a year now. It will be a year in January. And prior to that, I was actually living in Toronto, in Canada, working for EDC, the Accounts Receivable Insurance Department. So it's a pleasure to have you all here and to talk a bit more about the African Trade Insurance Agency. We can start up the presentation. For those of you who are not familiar with ATI, ATI is one of Africa's largest development financial institution, along with AFDB, the African Development Bank, Afrexim Bank, AFC, to name a few. So ATI's mandate basically is to provide, to facilitate and to encourage and otherwise develop the provision of and the support of for insurance, including co-insurance and reinsurance guarantees for purposes of trade investments, in supplement to those that may be offered by the public or the private sector, or in cooperation with the public or the private sector. Essentially, ATI at the moment is able to de-risk the full spectrum of debt and equity across the continent. And we currently insure an average of 1 to 2% of our member countries' GDP annually. So we are based in Nairobi with offices in 5 other countries, in Zambia, in Tanzania, in Uganda, and we opened just last year 2 new offices in West Africa, in Benin, Cotonou, and in Abidjan, Côte d'Ivoire. So we can jump to the 3rd slide. So yeah, I think that the 3rd, yeah, all right, perfect. So just to give you some background information, background story about ATI, the institution was created in 2001 after 7 African countries came together to understand how to attract more foreign direct investments into Africa. The World Bank, this was a World Bank-backed study, showed that political risk is the biggest deterrent to investments on the continent. So this led to the creation of the African Trade Insurance Agency, which is a multilateral organization registered with the United Nations. So we were set up as a multilateral for various reasons, but mainly to allow pooling of equity contributions from several countries, and thus that enabled us to acquire a capital base to facilitate acceptance in the financial markets. And also the reason was to operate independently from our member states so that we're susceptible to political, so that we're not susceptible, to political interference, and thus our underwriting decisions can be more easily accepted by international reinsurers. So ATI balances developmental objectives, such as increasing trade and investments to our member states, but we also have a need to carry out activities in accordance with sound business and prudent financial management practices. And we have a view as well to maintain, under all circumstances, an ability to meet our financial obligations. ATI's developmental role as well is also together with ATI, basically our developmental role as well is in addition to the fact that we also have a commercial role, and the fact that we have private and quasi-private shareholders, but we also have shareholding of African states, which makes it necessary for us to balance not-for-profit and for-profit interest. So we're not only a DFI, and we don't offer concessional guarantees. So I want to emphasize on that. We don't issue concessional guarantees. We also have a commercial mandate due to the fact that we do have private shareholders. We can move to the next slide. I think it's the milestone. Yeah, the milestones. Yeah, I think it's the previous slides, Anna. Yeah, perfect. So these are just milestone dates for ATI. We received an investment grade rating from S&P in 2008, which is fundamental for our business model. I will discuss this more in details later. Other key dates as well, we open our capital to foreign institutions, such as the Italian ECA, SACE, the UK Export Finance, UKF, and the Indian ECA, ECGC. And hopefully soon, maybe EDC will be a shareholder of ATI. Can only hope so. Also, one key date, last year our portfolio reached 5 billion in gross exposure, and this year we will close to approximately 6 billion. And this is just our gross exposure. In net, we'll keep in our book about 1 billion of exposure. In 2019, here we'll have Nigeria that is expected to complete membership into ATI. We have received already their equity contribution, but we're just waiting for the parliament to ratify our treaty agreement. And Ghana is actually now a full member of ATI. They just joined last month. So with Nigeria joining, which is one of the largest economy, actually the largest economy in Africa in terms of nominal GDP, we think that this will again attract more business on the continent and more ATI solutions. So we can move to the next slide, Ellen. So this just gives you a map of our current member states. There are 15 member states in total, which appear in purple on the map there. As I said, Ghana just joined, so I don't think this map is actually up to date. We should have included Ghana as well. But you will see that the majority of our member states are in East Africa. That's because initially the 7 countries who came together to form ATI were part of the COMESA, the Common Market for Eastern and Southern Africa. But we now have a focus to enlarge our footprint and to actually have more African countries join ATI. And with Benin and in Côte d'Ivoire in West Africa, we're hoping that new members will join as well ATI very soon. And we actually now have Egypt that's interested in joining. They've already showed their commitment to joining ATI. And we have Niger, Togo, Angola, and Mali that are about to join, we think probably next year. So ATI is definitely growing, which is fundamental for the way we function. So ATI, East African institution, but we're expanding more towards West Africa and Southern Africa. We can proceed to the next slide. So as I mentioned, we not only have member states that are a member of ATI, but also institutional members, and the list keeps growing. We see a strong interest from various institutions in Africa and abroad. So the AFDB and the African Development Bank and the Trade and Development Bank are multilateral institutions that are member of ATI, but we also have foreign ECAs that are members, such as SACE, UKF, and also ECGC, the Indian ECA. So we can move to the next slide. Yes, so this basically is a snapshot of our results in this first trimester of 2019. Our portfolio reached 5.9 billion in gross exposure. That's about 1 billion of net exposure in our books, which is quite remarkable. The demand for our product has grown exponentially over the last few years, so much so that a new class now of investors, pension funds and insurers are now tapping in the African debt market. So we see a growing interest in our products, which makes ATI really attractive to working with international lenders. So we can move to the next slide. Yes, so again, this relates to what I've just said. You can see on the graph how our exposure has grown exponentially across all our products, except for political violence and terrorism that has remained flat year over year. That's the curve there that you see in purple. The reason being that there is enough sufficient private sector insurance capacity on the market. Also, you will see that the reds on the graph there in reds, the curve there, you'll see that 70% of our core business, I don't know if you can see it, is basically derived from sovereign risk, so PRI insurance. More specifically, we can jump to the next slide, I guess, more specifically expropriation, non-honoring of sovereign and sub-sovereign obligation, confiscation, expropriation, nationalization, arbitration award default, currency inconvertibility, exchange transfer, and well, war, civil war and terrorism. The reason why PRI is one of our core products and represent about 70% of our offering is because ATI's business model is premised on its preferred creditor status. The security structure of guarantee of the policies that we issue is anchored on the treaty that establishes ATI, which is the treaty, the participation agreement that is signed between each member state and the equity capital of ATI contributed by all our shareholders. So the ATI treaty and participation agreement confer upon ATI de jure preferred creditor status in its member states. Basically what that means is that it obliges the member states to fully reimburse ATI and its reinsurers for any losses caused by the actions or the inaction of the states within 360 days of ATI paying a claim. And during this period, during the 360 days, ATI has the right to charge default interest after 180 days. This means that if all loss mitigation and negotiation recovery fail, ATI ultimately can debit the member state's capital contribution held by ATI. So generally, the continued non-resolution of an ATI sovereign claim would lead to ATI suspending underwriting of such risk in its member states, and eventually could lead to suspension of the member states from ATI's membership. So this is basically how our business model operates, and you'll know that political violence, terrorism, and sabotage policies or the risk of war, civil war, and embargo are excluded from the participation agreements because they are outside of the control of the sovereign. The same applies to commercial buyer or corporate credit risk, unless the loss was caused as a direct result of a defined political risk. So our other core products are CRI, commercial risk insurance, that protects corporate or financial institutions against the insolvency or the protracted default of their obligor. We also do issue performance bonds as well to ensure to protect the holder of the bonds against losses resulting from non-honoring of contractual obligations of a contractor. Actually, to be honest, ATI we do prefer to issue counter guarantees to banks in the local markets and provide them with the capacity. So on the performance bond, we do prefer to issue counter guarantees because there is capacity in the market, and we just support the local banks by issuing a counter guarantee if they lack capacity. So we can jump to the next slide. So this relates again to all our products and what we offer: investment risk insurance, credit insurance, surety bonds, preferably more counter guarantees, PVT, political violence and terrorism, although we haven't issued any policy in the last, I'd say maybe 3 to 4 years. And also we offer breach of contract insurance for energy products, particularly in the renewable energy sector, in the renewable energy space. So as I said at the beginning of the presentation, we insure the full spectrum of debt and equity into Africa, and PRI is basically our core and main product. So we can move on to the next slide. So this just gives you an example of the projects that we've guaranteed. I think there was one slide before that, Alan, before this one. Yes, the sovereign financing. This basically, it's something that we started doing last year. I'd mentioned that right now our gross exposure is about 6 billion our gross exposure, sorry, is about 6 billion at the moment. On the 6 billion, 1 billion is actually exposure that we do have in Benin, because we've managed to reprofile the Benin debts. What we've done actually is and we're doing more and more of these types of structure. If an ATI member state country, if a member country state-owned enterprise or a sovereign has a potential borrowing requirement in the region of, I'd say around 350 million, we do work with the Ministry of Finance to structure a credit wrap, which is a comprehensive non-payment policy to guarantee the obligation. So this allowed the Ministry of Finance or the state-owned enterprise to solicit competitive bids from capital markets investors, as the financing will benefit from an A-rated guarantee, which is ATIs credit rating. So we managed to enhance the credit papers considerably. So this also helped crowd in pension funds, insurers who frequently have an investment grade debt criteria, who cannot invest in credit papers that are speculative, which is the case for most African states. So by working with the MOF in this way, ATI helps lower the enterprise cost of financing, the state-owned enterprise cost of financing, or the sovereign cost of financing by at least 100 bips. And we can further help lengthen as well the debt maturity profile. So it also provides an alternative for foreign currency debt raising via bond markets or syndicated or bilateral loans. So we've been doing more and more of these structures in Benin, in Côte d'Ivoire as well. We've managed to refinance, to help refinance the state-owned refinery industry company of Côte d'Ivoire. So this is, we're doing more and more of this type of structure right now. So we can move on to the next slide. So we've been more and more involved as well in the energy space. We have facilitated the development of large wind farm and solar as well projects. We've provided breach of contract insurance protection to foreign lenders and IPPs in Kenya, but also in other key countries. In this case, in this particular example, the Lake Turkana wind farm, it's a wind farm project that we've insured here in Kenya. We were actually co-insuring this project with AFDB, who issued the 20 million partial risk guarantee. So AFDB came in first loss, and the ATI issued as well a second loss cover for up to 65 million. And the total project cost was 660 million. We've also developed certain products as well to respond to a demand in the renewable energy space. In particular, we have the regional liquidity support facility products that provides actually liquidity cover to IPPs. We can support them for up to a 6-month worth of invoices. This is we've seen more and more requests in this space, and this is why ATI has developed this particular project. And basically, these on-demand guarantees in the green energy space work as an alternative to partial risk guarantees. Most IPPs will require liquidity coverage to make sure that they have enough cash flow to support their projects. So the RLSF product is actually quite in demand at the moment at the ATI. The African Energy Guarantee Facility as well is another product that we've developed in conjunction with the European Investment Bank and the German Development Bank as well to mitigate risk in the energy space. So another project here in mining, we've provided a debt and equity finance to a mining project in Eastern Democratic Republic of Congo. This, I think, well, DRC is viewed as it is a risky market, and a number of private insurers wouldn't issue PRI coverage there. First, we view it as a member state countries, and as I said, we do have preferred creditor status in DRC and some leverage to advocate if we were to play a claim in DRC. So we do insure quite a number of projects there in DRC, in equity and debt as well. And we've supported lenders there in this space. Majority of them from China, actually. So they were just foreign lenders in the DRC. So we've insured the lenders against the risk of license revocation, war and civil disturbance, and likewise the equity investors against the confiscation, discrimination, expropriation, and nationalization.
Annabelle, perhaps you can explain. For example, we have license revocation. If a mining company has their license revoked, what happens next with ATI if you're covering that? Do they have to go do they have to go for arbitration, or do you deal with it?
Yes. Yeah, they'd have to go through arbitration. Well, we'll try first to obviously advocate with the political instances in the DRC. So our first, recourse will be first to advocate our preferred creditor status, but ultimately for a file to be for a claim to be admissible at ATI, we will the insured will have to go through arbitration. Yes. So just like any private insurers, we would want the insurer to go through through ISDS.
Okay, thanks.
So again, in the aviation space, we have worked with AFDB to cover an asset financing for Ethiopian Airlines. Ethiopian Airlines is one of the most, I'd say, performing airlines on the continent. They had purchased a new, aircraft, and from a foreign company. I cannot name the airline, the aircraft, the company, but they couldn't have access to an ECA financing at that time. So AFDB responded with 100% debt finance facility that was covered by ATI entirely at a competitive price, which obviously allowed AFDB, the African Development Bank, who is one of our shareholders, to lower their all-in debt costs for the borrower and stretch the debt tenor. So this was this enabled Ethiopian Airlines to purchase this aircraft without the backing of an ECA. So in this case, actually, somehow with our cover and EFDB's concessional loan, we were able to reduce their all-in debt cost for Ethiopian Airlines. And the transaction value was 159 million. So also in the railway sector, just as I mentioned, we do issue performance bonds. In this instance, we have enabled a Turkish contractor to perform, where we've issued actually an advance payment and performance guarantee to cover, to enable this Turkish contractor to work on a project to renovate and extend the railway infrastructure in Tanzania. The Tanzanian banks, the local banks didn't have the capacity to issue those bonds. So this Turkish contractor came to ATI and the limits were quite high and we were able to issue those bonds we also sought actually facultative reinsurance and we were able to issue those bonds. And this made the project successful. But as I mentioned, right now we will issue the bonds directly if there's no local capacity in the markets. If a local bank cannot issue the bonds, then we will issue the bonds directly. But in the normal course, in our business, we prefer to issue counter guarantees to banks. Just in the same way, at the moment, Ethiopia is actually working on a new project to develop a railway in Addis Ababa, in the capital city. And we have a number of foreign contractors who've reached out to us to issue performance bond and advance payment bond guarantee to the government. And we're looking at those requests as well because there's no local capacity in the market given the size, the size of the project. Move to the next slide. Yeah. Or maybe I think this is the last. I think this is the last slide, probably. Yeah. Yeah, and also, yes, ATI can also, we support our exporters. We do have, just like any ECA, we do try to support the African exporters as this is beneficial to the trade balance of our member state countries. And also we can look at the transaction in our non-member state countries, although we be limited in terms of tenor and size. But at the moment right now, ATI is trying to support exporters. In the accounts receivables insurance space, we issued a number of policies to our domestic suppliers and importers as well into African states. Right now, we're trying to focus more on helping exporters out of the African states. And this is basically one of our also core products. So we can look at single obligor transactions, or we can insure the whole turnover of African companies who are exporting to Europe, America, or the Middle East. So in this way, we act just like a traditional export credit agency. So yes, so basically ATI has a mandate to we have a developmental mandate. We do try to look at transactions that are beneficial to a member state from a developmental standpoint. We do pride ourselves from the fact that we've supported 470 million worth of investments that have contributed to 12 UN SDG Sustainable Development Goals. We do look at this transaction from a development mandate, and this sometimes when the market doesn't have capacity, or some countries are off risk by ECAs or other private insurers, we will look at transactions if they do have a developmental impact, particularly if these transactions are in our member state countries. So yes, so this attests again to ATI's global footprints. As I mentioned, we see there in purple our member state countries, but we do have exposure in non-member state countries. We insure them through our Pan-African mandates. The likes of Mozambique, Angola, Mauritania, or even South Africa. These are countries that are not member of ATI, but we look at transaction there, particularly the CRI space, commercial risk insurance, and to some extent, political risk insurance as well. These are deals, for instance, that we've done in Mauritania or Gabon. We've insured equity in these countries, but we are somehow limited in terms of size and tenure and the cover that we can take in these countries. Also, you will see in green the countries that have benefited from ATI solution and ATI's products. Canada, obviously, we've worked with EDC, we've reinsured EDC on a number of transactions. The US, Australia, China, Japan. Now we're looking more and more at Africa and interested in African debt. So these are all lenders and counterparties, lenders and insured that we've helped and who've benefited from our solutions. Yeah.
So Annabelle, can you tell us if an investor is looking for PRI for a project in Africa, what is the difference to them of using, let's say, AIG or Chubb or one of the other commercial insurers versus ATI?
Well, one thing's first, we do have a footprint in Africa, so we understand the risk, I would say, more than private insurers. And we do have more appetite as well, particularly in our member states, given that we do have a preferred creditor status. At the moment, for instance, right now, we've insured transaction in South Sudan, which is a country that would not be covered by private insurers, or even Somaliland or Eritrea. These are, countries that are viewed as difficult from the insurance markets. But for us, especially, for instance, a country like South Sudan is a member of ATI, so we do have we do need to support them given that they are member states. So I would say that we do understand more the risk. We do have a PCS status, which enable us to do more in terms of capacity. And we can actually also, we do have some leverage in terms of advocacy where we in case of a claim or issue between lender and the states, because in our member states, the shareholders sit on our boards, we will have some leverage and we'll be able to mitigate, probably more importantly than private insurers claim that arise.
Thanks. And can you talk a little bit about the claims payment system? I'm particularly looking at some of the people who are listening to this webinar. Have expressed to me their concern that if you buy political risk insurance, if an event happens, you may not easily obtain recovery, unlike, say, fire insurance. So I just wonder if you can speak to the policies of ATI in regard to payment.
Yes, well, as I mentioned, we do have an A-rated. We're A-rated by S&P, and this is because of our PCS, our preferred creditor status model, where we will be paying out claims ultimately, and we will try to make a recovery with the states in the PRI, in the PRI on our PRI product within 360 days. I think, well, the insurers are tested basically when a claim arises, and ATI so far has settled sovereign and sub-sovereign claims on behalf of the governments of Kenya, of Malawi, of Tanzania, and Zambia. Kenya, Malawi, Tanzania, and Zambia have all upheld ATI's preferred creditor status by preferentially settling all ATI sovereign and sub-sovereign claims. So far, we've paid out 19.5 million of sovereign and sub-sovereign claims since 2014, and 83.5 million of sovereign and sub-sovereign claims were payments. So we do have some leverage over the government to recover claims, but if we do need and we do have to pay a claim, then we will pay out this claim because we know that ultimately we will recover. ATI is a trusted, government partner and advocate as well on behalf of private sector investors to improve structures and the contracts and ultimately prevent claims and losses. So in this way, we do act as an intermediary, I would say, ultimately working to improve the investment climate in our member states. So we do not shy away from paying claims because this basically is why we have an A-rated. We're A-rated by S&P and A3 by Moody's, and we know that ultimately we will be able to make a recovery on the claim paid out. And in recent years, we also have taken practical measures to boost our preferred creditor status. We've increased the liaison with member state governments. We've hired a full-time membership liaison officer. We've adjusted as well our waiting period for reimbursement to 360 days. We've also introduced penalty interest after 180 days. So a state will ultimately, we will ultimately recover from any indemnification done in a country, but we do not shy away from paying claims. I mean, we have paid out 19.5 million of sovereign and sub-sovereign claims since 2014, and we'll continue in the background to recover those claims, and ultimately we will basically deduct the state's capital contribution into ATI if in the worst case scenario, which has happened just once in ATI history. With Tanzania, I think it's something that I can disclose, but yeah, it happened just once, and yeah, and we've managed to maintain our A rating by S&P.
Thanks. And you were talking previously about partial risk guarantees. Can you explain a little bit more to the audience about what they are?
Yes, so partial risk guarantees basically will cover private lenders or investors through shareholder loans against the risk of the government failing to perform its contractual obligations with respect to a private project. We've worked on these type of structures with the World Bank, IBRD, IDA, and as well as AFDB, where they will issue a partial risk guarantee on an outstanding loan, and ATI will come in a second loss, basically, to provide the cover for the tail of the risk. So we do like this type of structure, especially working with the World Bank, because they do have some as well leverage to working with a number of African states. We don't think that a state would default to the World Bank. But yeah, these are types of structure that we've worked on in Benin, in Cote d'Ivoire as well. And we're looking at the same type of structure as well in Angola at the moment. The government has raised a loan with private foreign lenders, and this loan will benefit from a partial risk guarantee from the World Bank, and ATI will provide the remainder of the cover on this transaction. So it's usually split about 40-60%, yeah, between the institution and ATI. So this allows us to provide a cover for and bridge any cover gap.
Thanks. And one of your last slides was dealing with exports from Africa,
Yeah.
ensuring those. And I was looking at it from the other perspective. Suppose that I'm a Canadian company that is importing goods from an African state. In what way can you help that company to secure that the goods will arrive? Because as we've said, in the past, often the method of assuring that is through a letter of credit. But what we have found is a lot of companies, they issue the letter of credit, the exporter in Africa or wherever it may be, draws on the letter of credit as they put the goods on the ship for delivery here. When the goods arrive, they're not as per the contract, or there's problems. Is there any kind of documentation or any kind of guarantees that you can provide to the Canadian importer that the goods will be as per the specifications?
As per the specification, well, in this space, honestly, except for if goods are sold on open terms, then we can look at insuring the receivable. But apart from that, in terms of commercial risk, we will, ensure, in case of non-payment or protected defaults, etc., coming from the buyer. But in this case, in this particular case, it's not something that we would cover in the case of if the goods arrive and they're not as per the contract. I can't think, because Alan, if I understand correctly, so if the goods were to arrive in Canada and they're not in their original states, you'd be wondering
exactly.
if ATI could be able to cover.
Because what we're seeing a lot of is, the shipping is done against a letter of credit, and the exporter, often in Southeast Asia, puts the goods on, draws on the LC. When the goods arrive, they're not, up to the quality standards. A lot of times that has to do with inspection, but in some cases the inspection can't be done. We've had clients who've bought pieces for helicopters, for example. You can't really examine those pieces,
Right,
at the port of exit, and they've had to, either send them back, toss them in the garbage, start again. So I'm just wondering whether there's any way that ATI can help the Canadian importer, and by that way help the exporter to secure that contract, knowing that ATI will protect the importer, helps the exporter to also make the deal. So there's nothing of that sort that you can do then.
No, in this case, not really. There's no product that I can think of, to be honest. So long that, if it's not disputed by the exporter, this is not something that we would typically cover. I'm just wondering, though, if an EC would have some appetite for that, or would have a specific product to cover or mitigate this type of risk. But from ATI's perspective, there's nothing that could. There's no solution that we can have for this particular type of situation, I'm afraid.
Okay, thanks.
Thank you.
Well, I think we've come to the end of our time for this. And I want to thank you, Annabelle, for agreeing to do this and to provide such a comprehensive overview of what ATI does. So I want to thank you for doing this. I want to thank all of the members of the audience for attending this. And we will be putting this on the Athabasca University website for students. So if those who weren't able to tune in today will be able to listen to it in the future. So thanks, everybody, and thank you, Annabelle.
Thank you very much.
And here's the list of contacts for the audience if they're interested in getting in touch with you or with other groups, other offices within ATI in Africa. So thank you all, and goodbye.
Thank you. Goodbye.